community association insurance. We talk about the different insurances that are available to your community association. Yes, ma'am. Well, for condos, HOAs in general, not for the individual homeowners. And so typically what happens, condos, as we stated earlier, are different. In a condo, the individual owner is responsible for everything inside of the walls. And the association is responsible for everything on the outside. Homeowners associations are similar. If you're in a HOA, you want to make sure that your HOA has insurance. One of the things that if you're on the board, how many people we have on the board of their HOA in here? All right, now let me ask another question. Does your board have D&O or E&O insurance? Okay, 2, 3. I saw about 6 or 7 hands go up, but half of them do and half of them don't. If you're on the board, okay, if you're on the board, number one, you've got to get insurance immediately, because your number one job, what happens if the clubhouse burns down tomorrow and there's no insurance to replace it? Then you as board members are responsible or could be held liable for that, okay? Number two, D&O insurance or E&O insurance is called directors and officers, or errors and omissions insurance. In fact, it's called errors and omissions insurance for directors and officers. You want to make sure that you have D&O and or E&O insurance if you are on a board. The D&O or E&O insurance protects you. Forget about protecting the association. You want to protect you first and foremost. You don't want someone to be able to come after you and take your house or your car because of a decision that you made on the board. So the number one thing you want to do is you want to get insurance, but number two, you want to make sure that you have D&O or E&O insurance. Directors and officers or errors and omissions insurance. If you are on a board in a subdivision or community association, it is a prerequisite. It is darn near mandatory. It should be mandatory for you to have D&O or E&O insurance. Say that again? The association pays for it. And it is to the benefit of the association, because there's going to be an election next year and someone else is going to be elected and they're going to need that D&O or E&O insurance.
I'm sorry, I came in late, but when I heard that word D&O?
D&O, directors and officers insurance. And really what it is actually E&O insurance. It is actually errors and omissions insurance for directors and officers. So if you are acting in your role as a director or officer on behalf of the association and you make a good faith judgment that you want to do A or B or X or Z, you cannot be held personally liable. The association nor its members cannot come try to seize your house or take your home because of a decision that you made in good faith as a board member. There's directors and officers insurance for that, and if your association doesn't have it, you need to make sure that they get it tomorrow.
But not just coverage, but adequate coverage.
There we go. And typically nonprofit boards will indemnify their board members, right? But it's easy, I mean, it's a nonprofit, so if they indemnify me and we get sued for $100,000 and they don't have it, they can indemnify me all they want to. They don't have it. So, yes, sir.
I cannot quote you premiums, but I can probably refer you to a few insurance agents that could. I think as a homeowner association as a whole, their coverage amount should depend on what amenities you have. If you have a pool or you have a golf course or something that's typically a little considered more dangerous and risky, then you want to make sure you have a higher coverage amount, right? But if you just have sidewalks, then you may not need the same amount of coverage that another homeowner association has. So I think it greatly depends on the type of amenities your homeowners association offers.
And that couldn't be more true, because now that I think about it, when we did our application with State Farm, they asked all those questions. What amenities do you have? What are we insuring, right? So it's based on the value of the items that are being insured, and it's also probably based on the replacement value of cost that it would cost to replace those items if they were not there. So I think you have to look at both of those. Right. Well, so I mean, are you typically $1 million to $2 million worth of coverage? I mean, it's hard to get more than $1 million, $2 million worth of damages. I mean, I guess theoretically you could get more than that, but I mean, it's pretty hard to get more. I mean, somebody would have to die. I mean, in order to get that, exceed that coverage. Say that again. Well, no. The whole reason you have insurance is so that it doesn't affect the board or the homeowners. The insurance companies pays it. We just had a lawsuit, that was I talked about earlier. They spent $200,000, and our insurance company spent $250,000 fighting. So that's $500,000 spent on a lawsuit. The person won $100,000, and so say that again. Oh, if it exceeds the amount for which the board is insured, then the board would have to come up. I mean, if you don't have enough insurance, then you've got to make up the difference yourself. Well, it can be passed on to the residents, because what would happen, the board would probably do a special assessment. If the board still owed another $500,000, the board would have to do a special assessment in order to meet that. So it can't be directly. They couldn't just say, oh, well, they're going to start garnishing money out of your account, right? I mean, no, but the board could pass a special assessment and pass that on to the homeowner. Typically, the independent brokers are the best, because they have access to additional coverages that may not have. I mean, we wound up getting State Farm. State Farm is good, Allstate is good, but there are limits on their coverage, and there are actually other independent insurance companies that probably provide more comprehensive coverage. Additionally, there's the D&O insurance, and there's also the Fidelity bond. The Fidelity bond is a type of insurance policy that protects against criminal theft by board members. So if a board member steals $20,000 to $50,000, and the homeowners are sitting around saying, hey, we can't pay the Georgia Power this month, how do we get that money back? Fidelity bond insurance will cover that.
Yes, because most policies do not cover acts that are willful or with malice. So like Marvin said, you would have to get that bond to specifically cover those instances.
I think it is a breach of your fiduciary duty, if you are a board member, to not have insurance at an HOA or condo association. I think it is an absolute breach of your fiduciary duty. And if my house got burned down and because there was no insurance, then I'd be coming after the association and you individually, okay? So here's how you fix it. Or here's at least one recommendation on how I would address fixing it. Number one, the first thing you need to do as a board member, you need to do a reserve study. Does anybody know what a reserve study is? How many people have had reserve studies done in their subdivision? A reserve study is basically a capital reserve study. How much capital will you need to pay for the upkeep, maintenance, and operations of the property that you have as part of the subdivision, particularly the common areas? How much will it cost the association to upkeep, maintain, and operate the common areas? The capital reserve study will tell you how much you will need to save every year. And I'm taking a long way to answer your question, but if you have this money, if you have enough money in the bank in reserves, then you won't. Yes, ma'am. So if your association has enough money in reserves, then it would never not have insurance. The reason they don't have insurance is because they don't have enough in reserves.
And you want to make sure you're electing a board that makes insurance a priority. I mean, more insurance never hurts. In my experience, the umbrella policies come with a lot of exceptions. And I would have to take a look at your specific policy, but a lot of them do except to organized events. So you just want to look to your policy to see, but it never hurts to get more insurance.
The previous question was about a personal umbrella policy. And so when we're talking about umbrella policy, you know, there are different type of umbrella policies. Someone's personal umbrella policy I don't think it's gonna be a hard stretch to get that to cover an association event. Now, if there's an association umbrella policy, for example, in my subdivision, John Whelan, I think, dropped our individual policy, allegedly had us on his master policy that he had, several subdivisions on or something like that. But so maybe there is an opportunity to be on a corporate umbrella policy, but the personal umbrella policy that the person was asking about previously, I don't think will cover association events. I think you are wise to have sought individual insurance for those events. I don't know that I would have gone that far. I probably would have just tried to wing it, but I mean, if it's an autism walk, right, that's one thing. Now, if it's the clubhouse Christmas party where it's liquor, then that's a whole different thing, right? So I think, kind of gauge it based on the event, but I think, you certainly did the prudent thing. There are engineers. An engineer will come out and say, okay, how much will it cost to repave the sidewalk? Or how much will it cost to repave the roads? How much will it cost for electrical? How much will it cost to maintain the clubhouse or to get a roof? And so the capital reserve study that we got was a 20-year study. And it basically said, okay, you need a minimum of $40,000 a year in reserves, excuse me, over the next 20 years in order to be able to upkeep, maintain, and operate all of the common area facilities in your subdivision. So as a new board member, that's the first thing you need to do. As a new board member, your number one priority is to protect the home value. Your number two priority is to find out what all does the association own, and then your number three priority is to buy some insurance and protect it. Okay, and then your number four priority is to buy some insurance to make sure that whatever decisions you make will not come back and affect you as an individual. But reserve study, you can find them if you just look up reserve studies online. Georgia reserve studies. I'm trying to think of this guy's name. And a lot of times they'll do a reserve study every 5 years. Even if, like the one we got done is for 20 years, but they tell you, every 5 years come back and re-examine it and update it and look at where you are and what needs to be done, what has been done. And it was great because they broke it down per year. They said, okay, these are the 5 projects you need to do in 2016. These are the 5 projects you need to do in 2017. It's a roadmap for your board as far as capital reserves and how to spend the capital reserve money. That's $40,000. So for us, that's not your operating budget. This is your capital reserve. Annually, yes. Typically, you cannot sue the board members. Typically, the board members are indemnified to the fullest extent by the law, allowed by law, for being sued. Now, if they breached their fiduciary duty, then maybe you could. But I don't know that what you described was necessarily a breach of the fiduciary duty, of their fiduciary duty.
Typically the court will chalk that up to that being a business judgment. And if it was a business judgment, they're not going to question whether it was a valid business judgment.
They made a good faith decision. Whether they made the decision in good faith, whether it was right or wrong, it was a decision that they made. Everybody's got to live with it. Against an individual board member, unless you can show that they breached their fiduciary duty. Now, if you putting, $200 a week in your bank account out of the association account, then I can prove breach of fiduciary duty, right? And so it's exactly what Attorney Kimbrough said. It's if the person is acting in good faith. If you're acting in good faith and you're making a business judgment while acting in good faith, they're not going to hold that against you. If you are purposely, putting your hand in the cookie jar to get some cookies, then that's a whole different situation. Yes. Well, hopefully the insurance company for the HOA will cover, because you don't want the HOA to have to cover that out of its operating budget. I mean, most HOAs operating budget is probably $50,000 to $100,000, a couple $100,000 or less a year. So they don't really have a lot of operating capital to cover those expenses and have a lot of fluctuation. His question was, does D&O or E&O insurance apply to a specific board member, or does it apply to the board as a whole? And it applies to the board. It also applies to the officers. I don't know if you all were here earlier. A lot of times people wind up wearing 2 or 3 hats just because there's no one else around to wear a hat. But the board sets the policy. They actually could hire specific officers to run the day-to-day operations, and typically what they do in that case is they hire the management company, in this case, instead of hiring specific managers or a specific officer like a president or a vice president. But typically in these small HOAs, you got one person that's the CEO, the president, and 2 or 3 things. But be careful. Typically, you cannot serve as the president and the secretary. Most bylaws, and I think maybe even state law, prevent the president from also serving as the secretary.
And if your HOA is big enough, you want to make sure you get D&O coverage for the committee members and sometimes even volunteers associated with the HOA as well. And again, you would just have to look to your policy to see what it excludes and what it includes.
Yes, because your social committee or your advisory board could be seen as an officer or an agent of the company.
Yeah.
It's the same thing. Same thing.